All right. Hello, everyone, and welcome to another Pepperstone live event talking about everything that's going on in the markets into statistically one of the worst months of the year, the one that brings the volatility, September. It's been a big move in gold, a big move in silver and other metals that we've been discussing over the last few weeks. And we've also seen some volatility kick in through other markets. My name's Thomas Atkinson. As always, I'm joined by Tyrone. And today we'll be talking about what's going on in all of these markets ahead of probably the most important jobs number that we've seen in some time. And that, of course, is non-farm payrolls, something that comes out the first Friday of every month. And Ty, this one is going to be big, isn't it? Because we've seen some revisions, we've seen some terrifying numbers almost, and the markets will react off this, wouldn't you think?
I agree. Welcome, everybody. Look, I think it's a very interesting number because we don't really know whether it can actually be believed or not. I'm not really sure what to expect. I'm not sure if the market has lost confidence in the way the numbers are released and who's running them, but hey, it's going to be interesting nonetheless. It will be a very interesting Friday, no question about that.
Absolutely. So we'll start off things by actually diving straight into the charts, and then we'll talk about how they're kind of acting ahead of numbers. Sometimes what we see, guys, is we have like a market that hits critical levels and it prepares for a big zone. So I always think of it as numbers are an excuse to make a big move. And in this case, of course, we have big moves already happening across the board. So we might get to some critical levels and we'll take a look at those later on in today's session. We'll start off here, though, with gold. Now, Ty, you and I have been talking about this for years now, and the strength in gold that we believe is there due to a myriad of macro factors and also price action factors. But as you can see here, we've got this really, really, really strong movement followed by a very heavy consolidation. And this is effectively a coil. So in essence, what you've got to think about it is it became an overcrowded trade. It actually back here was the most traded pair to the bull side of the year. It was so crowded to the bull side. And then it had to do in terms of into price action. So we see this kind of consolidation, and then we often see huge moves come off it. Now, last week, Ty, what did we see? We saw a breakout here of the pennant or symmetrical triangle, and they often can go quite the distance, can't they? So this is a huge momentum shift, and we're now pressing those all-time highs. So yeah, do you expect non-farm payrolls it to be somewhere in here and then possibly find a huge break at that point?
Yeah, I like what we see here with gold, Tom. That symmetrical triangle has been in play for quite some time, and we've been waiting for the bust. It could have easily gone either way, but we're not, unlike the indices, of course, we're quite happy for gold to go long. And really, yeah, in my mind, I think this pattern could actually fulfill its destiny and probably reach that 36 or 36.50, especially if we get a really poor jobs number, or even an inline number. I'm not so sure the market's going to accept, actually. I think that gold is one of those ones that you're going to be pretty happy to be in, I reckon, around September time, when the market, like you said earlier, is notoriously weak. Now, look, in the past, gold has also been a little bit weak in September as well. So we're not going to, it's not always the direct inverse of what the market actually does. But that said, gold's never been this strong at the start of September. So not for a long time anyway. So I like it. I do like what you see. And I think that potentially up to 3,700, like you say there, is a very strong possibility. Because when gold gets running, we all know it runs good and proper. And it runs on a completely different set of metrics to what makes it fair value. It doesn't rely on 2,000 companies reporting like the Russell does, of course. So yeah, I do like it. I like the move. I like what it's done for us most recently, and I think that there's still good potential there, regardless probably of what the job number is.
Yeah. So that's one way of looking at it. Obviously, the symmetrical. I also have the pennant way of looking at it, which gives you over 4,000, if you can believe it. So that's the if it continues in the same length style moves that has been going in. But let's actually dive into the smaller timeframes here and just look at the critical levels that really were passed. There's a couple of good signs. There was this, which is, of course, a low, a high, a lower low, and then it comes up. And you can see, and anyone in the chat will probably be able to tell us, that looks like a little inverse head and shoulders. And of course, that's in the direction of the daily, weekly, and monthly trend. It's always nice to have one of those. And then it breaks through and makes a higher high. And when this happened, you had quite a lot of good things starting to activate. And what you'll often notice is the market will prove pretty good setup. So I'll just get rid of all these drawings for a second. And what I'll do is I'll take the trend line here from the distance from there to the neckline, and then I'll extrapolate that out for you guys. And you can kind of see it was lining up. Really was telling us is that if we were going to see this breakout here, the chances were that it was pretty high that we were going to put pressure on here. We were also coming near the end of the symmetrical triangle, which is often very good time for it to break. You don't actually want it to continue on. If it gets too close to the end, then it can just look like this, and all of a sudden it completely breaks your pattern. Yeah, exactly, Ty. Yeah. So we don't want that. And in this case, it was making a series of lower highs in the symmetrical, and that's obviously now been broken with the 34.50 breakout. So for a lot of day traders, scalpers, this was probably one of the better entries. And then to some people, it was up here. But it wasn't just this one. It was also in silver. And silver's actually doing better than gold. And what you'll see here is silver had quite a few similar types of things. We had inverse head and shoulders in the direction of trend. We had pullbacks to very well traded zones. And of course, we had a breakout to a new high, which silver is hit on at the moment. So you can see here it's trading at 40.78. And we've been talking about these two metals for quite a while on the show. If you go back and watch Pepperstone's other series that we've done. And they've really been setting up mostly for bullish action. But I think the important thing to note here coming into non-farms is that we're seeing a bit of a change. We're seeing a little bit of weakness in the indices that we'll see in a moment. We've got strength in metals. We've got actually some weakness in crypto, which is interesting as well. That's some of the risk-ons are going off, and some of the hedges, considerable hedges like silver, gold, and even we're seeing dollar and oil starting to pick up. It's interesting how they're all doing this ahead of the non-farm. So what that's telling us, at least telling me, I think, Ty, is that it could be one of those major breakout events that may actually start a bit more trend because we're already starting to see money flow.
Yeah, absolutely. I think silver, both metals that we've just talked about have been very, very technical, and I think no one would be surprised to see the moves that we've seen because they were building up to it. But the technicals have been actually very, very good. So for all of you avid followers who have been following us for a little while, I think you'd see probably many patterns that we've been talking about for a long time playing out most recently on silver and gold. I think we like what we see, and I'm not so sure it's the end either. I think there's very strong possibilities that we might see one of those events that we could be talking about in a few years to come as to the catalyst. I like it.
Yeah, well, it looks like silver might be hitting those 42, 43s before you know it. But in terms of the way you look at price action, you've got to just say, well, what's it doing? You don't want to fight the trend too much when you're in a big macro trend such as this. And the ones in the direction of the weekly, the monthly, and the daily, they're often going with the flow. So you can see here the big gap up. I actually had a lot of people message me, Ty, and they said, oh, Tom, you can't say that this thing continues to rally because so we'll actually load up the RSI. And the reason why I want to load this up is, okay, the RSI is going to be overbought. I think anyone that knows the indicator, and you guys I'm sure do know this, is it's always going to be overbought. The thing is, though, it can stay overbought longer than people expect. So you may have an RSI that's at a above 70 zone for quite some time, and it can actually keep ramping. I think the thing in trading that I realized a long time ago, and so did Ty, I know, is that you don't want to be using these as the rule of not necessarily being involved in a trade. You want to instead say, okay, yes, I know it's overbought. Maybe that means I don't chase anymore. So if I'm in it, cool. If I'm not in it, maybe I don't chase. But I'm aware of it, but it doesn't mean that market's going to turn around, does it, Ty? I've seen these stay for a long time above these levels.
They can stay in a lot longer than you can stay solvent is the old saying. And it doesn't have to do anything, and they can stay in the overbought and oversold. And it's not just RSI, it can be stochastic, it can be MACD. A lot of those overbought and oversold oscillating indicators can stay in the territory of that. And it makes sense anyway. I mean, when the market's doing a particular thing, it makes sense that they would stay in that overbought or oversold domain. So don't ever think it has to do something because it's been there for too long. Let price action always lead you. It's very, very important. Or you can leave a lot of money on the table trying to reverse something.
Yeah, that's absolutely right. So let's have a look now at the markets that often make everything go round, which is, of course, the S&P 500 and the US indices. So we'll jump into each one of these. I think it's pretty clear that the US 500 is still technically in an upward trend. So for a lot of scalpers, day traders, and everybody else, we've really just been looking at the buy side for quite some time now. And the reason why is because that's the trend overall. Now, that may change, though, because we are in September. Now, if you don't know your statistics, September is I think it's the worst statistical month of the year if you run it all the way back to the 1920s. And it tends to bring in volatility. So usually sometime in August, we see volatility start to spike up, which you can track, by the way, by looking at the VIX. And then we've started to see that a little bit up. It's still very low, about 16 at the moment at the time of this recording. And then what tends to happen is we see more towards the bear side. Now, I've got a stat for you guys out there. Over the last 5 years, 4 Septembers have been bearish. Now, that doesn't mean it has to be bearish. In fact, the other year, which was last year, August was bearish. So again, it's the 3 months that generally bring the vol, isn't that tight? It's the August, September, and October months that tend to bring this volatility. So what are your thoughts coming into September, considering we've got this dull, slightly going up market? What do you think is actually happening here?
Yeah, I think that look, you can find Class A bearish divergence everywhere you look. It's on the RSI, it's on the MACD, it's on the stochastic, it's on momentum, it's on every indicator that you can find. It doesn't always guarantee that it's going to go down, but when you look at a market that is at all-time highs, I mean, we obviously know that it's been grinding up. Are we certain where the economy is in terms of health? Not really. It has all of the tariff talk and playing out, more importantly, probably of the tariff application. Has that all played out to the market satisfaction? Absolutely not. There's a lot of uncertainties, I think. And if you're a person looking at the stats and the odds, you see a market at an all-time high. The one thing that Tom didn't say is how many times the market is at an all-time high prior to going to September. And that's probably something that you need to take into consideration, because markets sell off sharper at all-time highs than they do at any other point. So it's almost like a perfect storm brewing, where we're at an all-time high, but uncertainty's probably never been more prevalent. And we're going into the weakest month of the year statistically. So I would be trading very precariously and cautiously if you're going long, but probably it doesn't mean the market's going to sell off and here comes a big sell-off either, by the way. We might just see a little bit of a dip, but I think you need to be aware of that dip, because as we know, markets that go up in a 2 steps forward, 1 step back approach are more healthy markets than ones that crash and then reverse completely. So ideally, what we want to see is a bit of a consolidation at a good level zone, and that might be 6150, it might be 6,000, it might be 5850. It may not even go that low. It might only be a couple of 100 points, the pullback. So I think that we want to be certainly looking for those technicals. I think it's probably a time where technical analysis, especially for a weakening market, is probably really, really important when you're doing your analysis. I think Tom's brought up there the 4-hour MACD, and we love MACD divergence when there is an alternate peak. So you can see we've got 2 peaks there and a trough that separates them. That MACD divergence tends to be stronger than a standard MACD that doesn't have a trough. And the reason for that is because the markets have more time to consolidate in that zone, that can even shift between the 12 and the 26 moving averages. So it's had a lot of time to consider that area, and it makes that MACD stronger, okay, the divergence stronger. So really important. Look, it doesn't guarantee anything, of course, but it puts the odds in your favor when you're lining up a lot of these indicators that are giving you a really, really good indication that there could be weakness at an all-time high going into the weakest time of the year.
Yeah. All right. Well, so we've got basically those levels. So let's just have a quick look here at the key zones. So obviously 63.50. If we've now made a higher high, then making a lower low would be the kind of key, I guess you would say, 4-hour trend change kind of idea, or 2-hour. Smaller time frames, some people have argued already that on a 5-minute, you've already started to see a little bit of weakness. I'm not really huge on taking these types of things, especially against massive trend, which has been very bullish, because they've been very bad trades. You've got to remember, taking small counter trends have predominantly been bad trades over the last 4 months. So the argument is 64.80, took a low here, rallied back up, hit the supply, and then now we're seeing, maybe the possibility of some weakness. That is possible. Really, the only stop loss levels that could be held are these two here. And I'm not sure that's a very solid technical setup. It's really just based on first principles of kind of changing the trend. It's not based on enough yet. To get further evidence, what we're going to need to see is a 6350 break to at least bring some trend change with you, and then 6200 will be the major support. So I think a lot of bulls will be looking at these two levels and saying, well, if we do get dips, these are the levels I'll be looking for structure, and I'll be looking for smaller time frame moves because, still I think that the trend up is better. Now, another thing that's been happening underneath the hood, guys, is a rotation. So if we have a look at the NASDAQ, it looks like a totally different market to the S&P. So here is the high. We've got a higher high. Then we've currently got a lower high that's been placed in, while the S&P 500 has, of course, made a higher high. And what that suggests is that we've got rotation. And you'll notice that if you watched, Pepperstone's Macro Edge last week, I talked about this. I talked about it also, I believe, 4 weeks ago now as well. It was happening a while ago, this rotation. You can actually see it. And that's the beauty of price action coming into these type of events, is you can actually see things happen before they hit the news media. And often we say if it's in the press, then it's obviously in the price. So we're at the kind of always at the forefront if you're doing technical analysis and bringing your data and your stats with it, because the media can't catch up to that just yet. Here we've been tapping this anchored VWAP levels that come off the lows. So at the moment, this seems to be the major kind of sup in the markets. And I think if we start dropping these levels tight, particularly 22,700, that would be a cause for concern. You lose the technology sector. Okay, other ones might do better, like the Russell, but they're puny. Yeah, 40+% of the S&P is all tech now.
Yeah, of course. Yeah, I think it's very important.
You like those levels?
You bring up a very good point. Yeah, there is a divergence in between the NAS and the S&P. I'm gonna throw a curveball at you, and I'm sure you're probably able to do it because you are a trading view sensation, Tom. But is it possible to put a Russell, NAS, and S&P 500 overlay to see the three, how they compare? I know you've done it before, comparing to each other.
Right. So we can just load it up over here. Oh, that's the XLE, which has definitely been improving. So we'll use the real markets here. We'll load up each one, and then we'll go with we'll just use IW. I always use that code. So these are the three major markets. Now what we'll do is we'll get rid of these lines because we don't need lines on this. I'm going to keep it as clean as we can. We'll keep the moving averages, and then we'll move this one over to a line chart as well. All right, so each one's labeled so you guys can see it here. And what I think Ty's going to be getting at probably is more the recent movement here. You can see the difference. There you go. That's probably what you want, I think. All right?
Yeah, it is. It is, absolutely it is. And I think that, when you look at it like that, I think it's a really good overview. You're not going to necessarily trade off this chart, but I think it gives you a really good overview of what, look, like it or not, the US indices generally lead the way for the world economies. They just do. They're the most sought after in terms of data. And when you look at it like this, you can see that there is a significant change in the purple, as we can see up there, 10% versus a 2 and 3%. Certainly something to watch, because if there is a reasonable sell-off, and it could be just a small pullback of even 4 or 5%, the one that's outperformed most recently is the one that's going to be the best trade on that short, because realistically it's the one that's got the most to give back. So what it's all about is bang for buck. If we're going to see a shortening of the markets and the three indices fall, what we want to be doing if we're shorting is actually looking for the CFD that's going to give us the most bang for buck with the same type of move across the indices. And I think that's probably why it's significant, knowing it's really picking your poison, isn't it, Tom? Like, you don't want to be shorting all three because you're effectively we call that a basket trade. But what you do want to be doing is giving the trade the one that's got the most amount of potential to give you the best return. And that's why overlaying three very, I guess you could call them, they do trade very, very closely. They're very in line. And you want to trade the one that's going to give you the best bang for buck. This is why a chart like this is important.
Mm-hmm. And you'll notice if you go back to May as well, April, near the bottoms of the Liberation Day lows, you can really see there's a big difference between the NASDAQ. Then it suddenly goes 25%. But as soon as you go somewhere over to, let's say, June, pretty much June to July mostly, there's a huge difference, only 4% in the NASDAQ. See, it's happened for a while. but you'll notice people only picked up on it maybe a week ago. So that's the beauty of doing this TA and doing charts such as this overlay here that Ty's brought up. So let's jump on over to the next one. So obviously the Russell, at the moment, I would say this actually is the only bullish looking major indice because the S&P is slightly bullish. It's dull, it's tough, but realistically, out a little bit. It could be a beneficiary as well, Ty, of maybe a pre-trade as well into NFP. So it's possible that people go, oh yeah, we think it's going to be, I don't know, maybe a slightly weak jobs number, which means more rate cuts possible because we now know the Federal Reserve obviously is probably going to do a rate cut. Well, I think they've all but almost said it, but we'll go with higher percentage according to the economists. And 2450 is going to be a big target here, or 2440 for the Russell, because that will take it to a critical level. So sometimes into non-farms, you'd be surprised markets can just kind of ramp into key levels. Now, it could be this one here, which is a 2300, or it could be 2440. But I would not be surprised to hit one of those levels ahead of non-farms. It's not that I know exactly which direction it is. The current trend is up, so you'd have to think it's more towards the bull end. But it's interesting that you often do find yourself at these keys, don't you, just before those non-farms?
Absolutely, and I think that it could drag. It's almost like a magnetic field dragging price to those key levels prior to the event. I don't expect that it's going to be sitting here. We know through history that a lot of the major indices, dollar index, all of the key trading instruments generally gravitate to a very key level prior to a very major event. And I think that I really believe that this could go to 2320 or 2440 just as easily as each other. I wouldn't be surprised at either of those over the next 3 days. But if it does, if the anticipation is high that it's going to be a potentially good number, yeah, the first major target you've got marked there around that sort of 2440 is definitely something that I would be keeping an eye on.
And again, just to really point this out, you can see I've got here a couple of just interesting levels. So obviously these were created before these things actually occurred. But I just want to kind of point this out, that it says here market turns bullish. That's because what happens when you critically break this level, you've actually broken that structure, and you tend to see flows come in. And then you can see the first pullback was actually bought up pretty heavily. There was actually a beautiful tweezer trade in there, if you wish to go and do some research on it and check it out, that I think was really awesome. All right, let's move from there to the dollar quickly, oil, and then we'll go over to some crypto. So let's have a quick look here at the dollar. I think that the dollar is very, 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 you could say range bound. I think it's definitely coiling for something. Now, this has become the most crowded trade. About a month, 2 months ago, funnily enough, when it loaded off, we saw it as it was the most shorted pair, I think, one of the most crowded trades. It's since then just kind of consolidated. I'd say we don't need to spend too much time on the dollar yet at the moment, Ty, but breakouts to the upside above 99 or breakouts below 97, I think those are the two levels that longer term traders and also momentum flow traders will be looking at. Would you agree with both those levels?
Absolutely. Yeah, and I think that when we do get a proper daily break of either of those two levels, we can probably relatively be comfortable that the next key levels are going to be hit. Those key levels are 101.80 or the low of 96. And I think they're the two targets I'd be aiming for.
Very good. All right. Well, from there to oil. Now, we've pretty much consistently said we don't like oil for a while, and I started liking it about a week and a half ago. I really was not a fan, and it still is a very dangerous trade. I think people need to be aware that it's geopolitical. So that means that weekends are dangerous for oil because weird things can happen, guys, and especially in 2025, Absolutely. As you know. So you've got to be careful out there when trading oil. But we saw some improvements here. We had, of course, a high breakout that happened only a few days ago. Then the market pulled back into the range. We also saw an early move by UK oil or Brent. So I always suggest that you do a side-by-side comparison between, similar to what we were doing with the Russell before, US oil and UK oil, and you'll actually see UK oil broke first, which gave us a little bit of an idea that this might improve. Now, oil since then has actually started to really ramp it up, and I think it looks okay on the charts. Now, it's been historically down, so only daily is currently bullish. Like if you look at the weekly, it still would be in a downward trend. But I guess you could argue both ways actually because of the rally it had here, and still didn't ever take that low out. But still, it's some big moves. So I like oil. I actually think it's looking more bullish, tied towards 67.50. What are your thoughts on oil? Do you like this base? Is it enough or not enough yet? Broken the 20?
I think the base is good. I think it's a pretty good base, and even the weekly there, you can see almost a tweezer setup with a push up. It has done enough, I think, to start to aim for that 67.50. And if we get a break of that, I think the 72 looks really good as well. So I think there are two key levels for oil on the flip side. I think that sort of 67 area, and then that 72 area is also a very key zone. So it can happen very quickly, as you say. I mean, oil does move very, very fast as well, but it's done enough consolidation, I think, to start taking it a little bit more seriously. It is still a dangerous trade. There's no question about that. But the technicals now have given us enough confidence that if a setup arises, we know the key levels are there. So a series of higher highs and higher lows on a smaller time frame. Happy to play the game to 67.50 to 68. But a break of that, and there's probably $4 above that. That could be easy pickings if it does get enough momentum to break through that level properly.
Mm-hmm. Yeah. And again, ahead of non-farm, seeing the basing structure could be a big move because oil is going to be very sensitive to interest rates. It's one of the most sensitive interest rate trades. So therefore, if we get big moves on interest rates due to the non-farm payrolls number, that's what's kind of at stake. So, we may see possibly highs before the non-farms and then see some large moves. Now, just to reiterate, we've seen nice movements in Chinese stocks since Barber's result was pretty strong yesterday. That's been, I just wanted to show again something we've brought up on the show, which is the 50 moving average, continuously making series of higher highs, barely, and then it's come back to the 50. And you can see here the consistency of our 1-2 setup. If you're not sure what the 1-2 setup is, you can go back through Pepperstone's library. We've got quite a lot, but that's one of our favorite moving averages, the 50 moving average. And it's been hit quite a few times. And it just shows, like, again, that the power of using decent technical analysis on top. And it can be quite simple. Now, Bitcoin, I've got two levels here. I don't think it's done enough to necessarily say it's fully based yet. Broke under 112, big level. A lot of people, a lot of liquidations, huge trades coming in here as well, like monsters. What are your thoughts on this kind of craziness? Are we at a point? I mean, it's okay level, 108, but is that enough for you yet?
No, not really. Look, I mean, on face value, you take away the label, we look at price action only. That looks extraordinarily bearish to me. We've got a 20-50 moving average cross on the daily. That hasn't happened since it was at 93,000, just a long, long way away. So I would look at that and say definitely opportunities for, I was sort of thinking 106 probably as a preliminary target. That I think would have a better basing opportunity. It's getting close. I mean, look, it hit there, and it would want to hold there at 106. I think that's probably the level. That's probably the key level, 106. After that, if 106 doesn't hold, I think we might see a night in front of it before too long. Because that's extraordinarily bearish. No question about that.
And the 98K as well is about 21% down if it does hit that, which would be consistent with a lot of bearish sell-offs that Bitcoin's gone through in the past if you look at previous cycles. Also, interestingly, I guess just to note on this, other than those key zones looking for structure, Ethereum and Solana and XRP and others are holding better. So what that basically is telling us is that there's a movement to the alt market. Bitcoin often then finds a bit of market money coming out of it, and then sometimes it can actually find one last move. There are some very important levels in the 90s that it needs to hold. So, important times for Bitcoin, and it could be also ahead in non-farms. So, guys, with the non-farm payrolls coming this week, this is arguably now the most important, jobs, or the most important actual single figure that you get out of anything in the world. It used to be, of course, CPI, but inflation numbers have since moderated, so they've been not that interesting for a little while. Non-farms are. What you're actually looking for if you want to read the numbers is going to be looking at the revisions. So usually you get a number, and then the market will be reacting off what about the revisions, because we've seen some shocking revisions in recent times. So that is the last two revisions, so usually the last 2 months, plus the jobs number right now. And you're going to see probably yields move. So make sure to watch your yields. That's going to be the 2-year in particular. And if it goes down a lot, that could, of course, be, even though it may be bad, because it may be the economy is actually weakening, what that's going to trigger is probably the idea of more Fed cuts. That's one of those ones that's really hard to interpret. Some people are going to say, well, a bad number is a good number, which we've seen before, haven't we, Ty? It reminds me a lot of 2000, was it 15 or something, 14, when we had a bad numbers and then the Fed used to cut. And that, of course, was allowing the market just to keep going up. So remember, the market is all about the Fed. How many cuts are we going to get? Is this bad enough to cause a recession, or is this actually just, it's okay, we can kind of deal with it? I would say less interpretation of the event itself, because that's very difficult, and more interpretation of the flow and the breaks. So I'd be looking for some of the breaks levels that we've looked at today, and of course, key zones to be taken out, because if that happens, plus you get a move in yields, it could be a good momentum move.
Absolutely. So, okay, everyone, well, thank you for joining us today. Hopefully, you've been able to get a little bit of an insight into what's going on this week with non-farm payrolls, but also just really pay attention to the key levels that we're at on a lot of the major trading instruments that we've talked about, that we talk in every fortnight. There's a lot of information coming out, but the most important number is non-farm payrolls Friday, so just be certainly careful about that one. And I really look forward, Tom, to the next Tuesday webinar that we do in a fortnight's time to see what the ramifications of this are, because I'm pretty comfortable that we're going to be considerably far from the levels that we're at now. I'm not going to say whether it's up or down, but I don't think we're going to be where we are now. So looking forward to that.
Yeah. No, absolutely. I think there's going to be some pretty large moves in September. So remember, guys, keep vigilant, keep safe. Make sure you trade with risk parameters around, because this is the months that matter in that. And I think the volatility is just going to continue through the rest of the year. And we knew that at the start of 2025. We got that big sell-off. Now we're probably going to see volatility again, up, down, and all around. So get expected for a good technical market, I would say. From all of us at Pepperstone, thank you so much for watching. If you are watching live in replay mode, please subscribe down below, give it a thumbs up, and also place a comment. Catch you now. Bye, guys. Yeah.
Thanks, everyone. Bye.